A society stays stable when housing is a place to live, not a strategy to win. For decades in the United States, owning a home wasn't just a milestone, it was the financial backbone of the middle class. It meant stability, predictable monthly payments, a fixed cost in a world of rising prices, a way to build equity instead of paying rent. Homeownership was how families built wealth slowly, without speculation, without leverage games, without financial engineering. You worked, you saved, you bought, you stayed, and over time, the house became your largest asset. But today, for millions of Americans, that pathway feels increasingly out of reach. Not because people stopped working, not because ambition disappeared, but because the numbers no longer align. For decades now, home prices have grown faster than incomes. And when that gap compounds over 30 or 40 years, it fundamentally changes what affordable means. The American dream didn't disappear overnight. It drifted away, gradually, mathematically, quietly. Let's look at the long-term data. Since 1985, U.S. median home prices have increased roughly 415%. In that same period, median household incomes increased about 255%. At first glance, both numbers seem large, but the difference between them is what matters. When asset prices grow significantly faster than wages, ownership becomes increasingly difficult for new entrants. This isn't a short-term spike, it's a multi-decade divergence. Another way analysts measure this is the price-to-income ratio. This ratio compares the median home price to the median household income. Historically in the US, that ratio hovered closer to 3, meaning the typical home cost about 3 times the typical household's annual income. Today, in 2025, the median home price is roughly 5 times median household income. That may not sound dramatic at first, but moving from 3 to 5 is not a small shift. It means housing costs have structurally decoupled from wages. And historically, when this ratio rises significantly above 4, housing markets tend to be considered stretched or overheated. The early 1990s saw much lower ratios. Even the early 2000s housing bubble did not sustain a 5 times national ratio for long. Today, we are back near those highs. This growing gap is not just a statistic. It determines who can buy, who must rent, and who is locked out entirely. Right now, the median price for a U.S. home is around $410,000 or more. That's not Manhattan luxury, not Silicon Valley tech villas, not beachfront property. That's the middle, the statistical center of the American housing market. Now pause for a second. If the median household earns roughly $80,000 per year, that means the typical home costs more than 5 full years of gross income. And that's before taxes, before health insurance, before student loans, before childcare, before everything else life requires. In previous generations, housing absorbed a manageable share of income. Today, it absorbs financial capacity itself. A traditional 20% down payment on a $410,000 home means coming up with more than $80,000 up front. For many households, that's multiple years of disciplined saving, assuming no emergency happens along the way. But here's where the math gets even tighter. To qualify for a mortgage on a median-priced home, analysts estimate a household may need to earn around $113,000 per year. That's not to live comfortably. That's simply to qualify under current lending standards, which means a household earning $80,000 is not just a little short. They're structurally outside the qualification range. And that's the shift. Housing hasn't just become expensive, it has become gated. Through income thresholds, credit scoring models, and monthly payment ratios, ownership is no longer about wanting it. It's about mathematically clearing a barrier. It's not just that prices are high, it's that affordability has collapsed. Before the pandemic, in 2019, nearly half of homes sold in the United States were considered affordable to households earning the median income. That wasn't perfect, but it meant there was breathing room. Today, only about 21% of homes are affordable to similar households. Think about what that means. More than 3 out of 4 homes on the market are out of reach for the average American family. That's not a local anomaly. That's a national structural shift. And when affordability falls this sharply, it doesn't just slow buyers, it reshapes behavior. People delay purchasing, they stretch finances, they take on riskier loan structures, or they simply exit the market entirely. Affordability indexes track the share of income required to cover mortgage payments at prevailing rates. And today, that share is near historic extremes. In many metro areas, mortgage payments consume 35%, 40%, sometimes even 45% of gross income. That leaves very little room for error. One job disruption, one medical bill, one economic shock, and the margin disappears. Housing used to be a stabilizer. Now, for many households, it has become a financial stress multiplier. And when affordability falls this far, it doesn't just affect individuals. It alters the structure of the entire housing ladder. First-time buyers can't enter. Move-up buyers can't move. Inventory freezes, and the system tightens. A big reason prices stay high is supply constraints. The homeowner vacancy rate, a key measure of how many homes are actually for sale, is very low, around 1.2%, suggesting limited inventory. To put that in perspective, a healthy housing market typically operates with more breathing room. When vacancy falls this low, buyers aren't competing against the market. They're competing against each other. Low vacancy means fewer options for buyers and upward pressure on prices. And here's the important part. This isn't just about not building enough houses last year. It's about a decade of underbuilding after the 2008 financial crisis. Construction slowed dramatically after the crash and never fully caught up with population growth. So today's shortage isn't temporary, it's cumulative. And cumulative shortages are hard to fix quickly because you can't build millions of homes overnight. Mortgage costs matter too. After years of historically low interest rates during the pandemic, mortgage rates climbed sharply, then hovered near 6 to 7% recently. And small changes in rates have massive effects on monthly payments. A 3% mortgage and a 7% mortgage are two completely different financial worlds. Higher rates push monthly payments up even if home prices stop rising. That's what makes this environment uniquely difficult. Prices didn't fall enough to offset the rise in rates. As a result, homeownership costs, including principal, interest, insurance, and taxes, remain high, with median monthly owner costs over $2,000 per month. For many households, that's more than rent used to be. This squeezes budgets and delays purchases. And unlike home prices, monthly payments are what people actually feel. You don't buy a house based on the sticker price. You buy based on what you owe every month. And that number has become intimidating. Another emerging trend. Homeowners are staying in their homes longer than at any time in over 20 years. Average ownership duration reached around 8.6 years in 2025, roughly double the early 2000s average. Why? Because millions of homeowners locked in mortgages at 2.5% to 3%. Giving that up to buy another house at 6 to 7% would double their financing cost. Even if they want to move, even if their family grew, even if their job changed. This is called the lock-in effect, and it quietly freezes mobility. The result, even fewer homes for sale, which pushes inventory lower, which keeps prices elevated. It's a feedback loop. Despite high prices, transactions are slow. In early 2026, existing home sales were around 3.9 million units annually, the lowest level in years. That's a key signal, because a healthy housing market isn't just about prices, it's about movement. Homes changing hands, families upgrading, young buyers entering. Right now, prices are high, but activity is low. That combination tells us something important. The market isn't booming, it's stuck. And when fewer homes change hands, supply tightens further, and affordability doesn't improve. Combine these forces, home prices far above historical income ratios, limited inventory and low vacancy, YDAWONs, high mortgage rates, long ownership durations, and the result is unsurprising. First-time buyers have been priced out or forced to wait longer. But here's what makes this especially important. First-time buyers are not just another group in the market. They are the entry point. They are the bottom of the ladder. And when the bottom of the ladder disappears, the entire system slows down. Because first-time buyers allow existing homeowners to sell. Existing homeowners then move up. And that movement creates liquidity. Without them, the chain breaks. Now consider the savings challenge. A 20% down payment on a median home can exceed $80,000. Even a 10% down payment can require years of disciplined saving. Meanwhile, rents remain high, student debt burdens remain elevated, and everyday costs, from childcare to insurance, consume income. So buyers aren't just competing with other families, they're competing with time, and time is expensive. Because while you save, prices may continue rising, rates may fluctuate, and qualification standards may tighten. That uncertainty alone keeps many would-be buyers on the sidelines. It's structural. For decades, home prices have gradually decoupled from wage growth. That means the system itself shifted. Housing stopped behaving like a consumption good and started behaving like a financial asset. And financial assets respond to capital flows. Low interest rates increase borrowing power. Global capital seeks stable returns. Institutional investors enter markets. Private equity funds expand portfolios. Each of these forces adds demand, but supply, because of zoning rules, land constraints, and construction costs, cannot respond instantly. So the gap widens, and here's the deeper implication. When housing becomes primarily a store of wealth, policies tend to protect asset values, not necessarily access. That doesn't require conspiracy, it's simply how incentives evolve. Homeowners prefer stable or rising prices. Local governments rely on property taxes. Financial institutions rely on mortgage volumes. The system, over time, begins reinforcing itself. Housing is no longer only about shelter, it's about how capital and credit shape opportunity. And once that shift happens, reversing it becomes complicated, because lowering prices would mean reducing asset values for millions of households. That's politically and economically sensitive, which is why affordability problems tend to persist. When housing is unaffordable and locked up, the effects ripple outward. This is not just about homeownership, it's about mobility. People delay moving for jobs. A worker might get a better offer in another city, but moving means paying higher rent or entering a more expensive housing market, so they stay. That decision seems small, but multiplied across millions of households, it reduces labor mobility. And labor mobility is one of the core strengths of the US economy. Historically, Americans moved toward opportunity, toward growth cities, toward better wages, toward expanding industries. But when housing costs block that movement, opportunity becomes geographically limited. Renters stay stuck. Young adults live with parents longer. In recent years, more than half of adults under 30 have lived at home at some point. That's not necessarily cultural, it's economic. Cities lose flexibility. Employers struggle to attract talent in high-cost areas without offering much higher wages. And when wages rise primarily to offset housing, that doesn't increase productivity. It simply reallocates income. Over time, this can slow growth, because money flows into housing, and which is largely a non-productive asset, instead of flowing into innovation, business expansion, or entrepreneurial risk. Affordable housing isn't just a personal milestone, it's part of how efficiently an economy allocates talent. When access is constrained, efficiency declines. So is this permanent? Not necessarily. Housing markets are cyclical. Mortgage rates could decline. If rates fall meaningfully, monthly payments would drop, even if prices remain elevated. New construction could increase. If builders are incentivized to focus on entry-level housing, supply could expand. Local zoning reforms in some states have already begun allowing denser development. That's a structural shift. But here's the key. Affordability doesn't automatically fix itself. If rates fall too quickly, demand could surge again, pushing prices back up. If wages stagnate, lower rates alone won't solve the income gap. And if supply increases only at the high end, entry-level buyers still struggle. So, improvement requires alignment. Sustainable wage growth, since supply expansion, stable credit markets, policy coordination. Without that alignment, the pressure remains. So what does this mean? Owning a home is not impossible everywhere. There are regions where price-to-income ratios remain reasonable. But in many major metro areas, homeownership is no longer the default next step for adulthood. And that's a psychological shift. For decades, buying a home symbolized arrival, stability, progress. Today, for many young professionals, it represents risk, debt concentration, geographic lock-in, not because people are irresponsible, not because they lack discipline, but because the economic framework shifted. And access became conditional, conditional on income level, conditional on location, conditional on timing. That's different from previous generations. For most Americans today, homes cost more relative to income than decades ago. Mortgage costs have risen from historic lows. Inventory is constrained, first-time buyers are marginalized, and the data shows it clearly. Housing affordability in the US is near historic lows. That's not opinion. That's measurable. And when housing feels impossible, it reshapes life decisions. When people delay buying, they delay moving. When they delay moving, they delay careers. When they delay careers, they delay families. Housing sits at the center of economic life. And when it shifts from being a place to live to a strategy to compete, stability becomes harder to maintain. The question isn't whether the market will change. It always does. The real question is, will access expand again, or will homeownership become a privilege rather than a milestone?